Hello, sexy future millionaires, and welcome back to another episode of attempting to turn 10k to 100k over time. So, as you can see here from my portfolio, I haven't bought anything yet because, as mentioned from my weekly markets update uploaded earlier on late Sunday Singapore time, that I was still waiting to see if there are any opportunities to to buy any stocks created from the volatility from the upcoming Fed rate cut announcement. Before that, we're seeing a lot of volatility towards the upside. I think that's largely because of what we're seeing from Tesla's, Elon Musk insider buying of about $1 billion worth of shares, and also Google's surgence because of Gemini's traffic being better than expected as compared to ChatGPT. So today's episode will be a little bit more different as usual because I want to share about my top 5 investing mistakes I made over my investing career, right? And I hope it could help you avoid these mistakes and also give you some tips on how you can better from this. So number 1, right, I think is that I was extremely emotional with my investing decisions. So I think most other mistakes that you see later on stem from this, right? So number 1, right, which is fear and greed are the most strongest of human emotions in life and investing. So my emotions took the better of me over a couple of times. So for one example is I added very strongly on losing stocks and taking profits very quickly on my winners. So one example would be if you take a look at Alibaba shares. So I made the mistake of averaging down on my Alibaba shares because I thought it was a value buy. So as you can see here over the past 5 years, right, stock prices hit a high during COVID and then they continue to pull back very strongly. This is while the entire time the US markets were rallying, by the way. So over here, I started to enter, and then as it drops further, I continued to enter thinking that it's a value buy, it's a value buy, it's a value buy. But my mistake was me alone as what I think is different from what the overall market thinks. So there is a reason why the stock is prices are continuing to drop. So number 1 is because the narrative was going against Alibaba at the point of time, right? The whole tech industry in China was being cracked down by the government. This means that its earnings and revenue growth drivers are sort of capped, right, in a sense. And also Jack Ma was also being hounded by the government, and he didn't appear for the longest of time. And so number 1 is do not fight the narrative. Do not add on to your losing stocks thinking that it will just rebound over time without any catalyst. So that's a surefire way to carry the bags. And number 2 is taking profits very quickly on my winner. So one very, very recent example will be one stock called Oscar Health. Right? It's a very, very recent example. So if you look at the company's let's go to legacy view. Share price very recently, right, over the past 6 months, for example, I entered Oscar at around $14 per share, right? I looked at the fundamentals of the company. Yes, there are some headwinds facing it, but overall it's still very solid. It's founder-led, and they even brought in a very successful ex-CEO to run the company. And if you look at its valuation, it's pretty decent as well. So I added onto the stock, and when the stock moved up a bit, right, to around the $16 range, I just took profits because I just saw that on my profile, on my account, right, it's showing green. So I was very tempted to take profits, and then there was any pullback, I will feel very uncomfortable, and I will set trailing stop losses, which is wrong, right? I shouldn't have done that because I had the conviction that the company would have long-term growth prospects. So why did I just take profit so quickly? I should have let it ride out. And then, as expected, I missed a very decent run up to $20. And even from a technical perspective, this is a very much better area to take profits, right? Rather than somewhere here in the middle of nowhere. This was near the previous local high. So even from a technical trader perspective, this is a better place to take profits. So never, never, ever be emotional when you are investing and trading. And also don't ever give in to FOMO when it no longer makes sense. So for example, back in 2021 and 2022, right, everybody was buying meme stocks and things like that. I was on the sideline all the way. I felt very very pressured to do something. Why are my friends making money? Why did I not buy into this investment? I should have bought in and do that. But at the same time, I was fighting the more rational side of myself, thinking that, oh, this is a bubble. My valuations are already overly extended. I should have just sit out for now. And well, eventually I gave in to my FOMO and I bought some NFTs near the top, which is silly of me, right? Because fundamentally NFTs may not do anything at that point of time. There wasn't like a very usable and scalable tech tool as well. There's no distribution, and I just bought into some random projects because I thought the art was nice. But then again, me buying in signaled the top, right? And after a few weeks later, it did pop, and then never really covered. I don't even know where my NFTs are now at this moment. So never ever give in the FOMO when it doesn't make sense to you. You should always stick to your plan and invest in what's comfortable. Do not, because of your friends, they're investing in all these kind of meme stocks, growth stocks. You do that too because you feel that you have to give in to this FOMO. But if you do give in your FOMO, it may not be the best for you because you're not managing the positions that you're comfortable with. They're not aligned with your investment philosophy, and this will lead you to be more emotional as well, right? Your fear and greed will have like a exponential or compound expanded effects on you, and you'll be all over the place emotional wise. And number two is not knowing what I'm actually buying. So you should always do your research and understand the companies that you're buying into. So what sector do they operate in? How does the company make money? What drives the business growth going ahead? How strong is its balance sheet and cash flows? What are the downside risks to owning the stock? And who owns the company? The founders, any corporate CEOs, or who owns the most stake in the company? So you should, before you buy any stock, you should look at the fundamentals of the company, right? You should consider its financials, balance sheet health, growth, etc., margins, right? Key ratios, understand its revenue segments, right? Understand its historical earnings, how did it perform historically. So this will give you a sense of how accurate and and capable management is in hitting targets. What are its most recent news and development of the company that could give you a sense into the business, risk or catalyst going ahead, right? So always do your research because previously in the past I lost money from buying random stock that I don't really understand what the company is doing, right? Just to open up a chart and then like, oh, it shows a nice pattern, I'm going to invest in this company. But what I should have done is taken a trade instead or investing, because investing in trading is different, right? Because understanding the company well will help you build conviction, it helps you remain rational, and stops you from making like stupid emotional decision, which could lead you to lose money. So always do your research. And number three is when people say valuations do not matter, until it does. So I remember back in 2021, 2022, growth stock was the thing. So everybody threw all your valuation metrics out of the window, right? Your PE ratios, the PES ratio, don't matter anymore. But what happened after is that the bubble popped and the market did pull back strongly. So mean reversion is always a thing, and bubbles do pop over time. So it's very important that you understand market cycles, sentiment cycles, and liquidity cycles. Always know at which point of the euphoria you're deploying your capital at, and use historical valuations as a guide. But higher can go higher, as I explained in my previous videos with Palantir. But one good example is I lost money in Lemonade in the past, right? So let me just show you. I bought it when prices were at quite a decent high back in 2021, 22, right? I bought it near, if I recall, around this level. But then again, valuations did come back down to earth, and then look at that, the stock just went down to over $20. So took a big loss here. I sold out at around 50 plus, so at least I have a technical stop loss in place. But understanding valuation cycles could help me prevent making these losses, right? So always use your valuations as a guide. So you can use key ratios here. You look at the historical PES ratio over the past, say, 10 years. So I bought it when the stock was over here. Rather, you should start to buy when things are starting to slow down. If you look at the company's fundamentals, it is starting to show growth and there's catalyst going ahead to drive the company forward. This is where you should buy, and not where at insane valuation matrix you invest heavily, because whether the company can sustain this growth going ahead is another thing, right? And number 4, which is paying too much attention to media headlines. So understand that, let's look at the news tab. news, right? The idea of news, and especially from media institutions, is to always generate interest and eyeballs, and they do that by invoking your emotions. So over time, right? In the past I used to just keep looking at news headlines, understanding oh shit, there's gonna be a crash coming up because so and so said this, or also there's another war in some of the country, or this will probably boost stock prices down. But over the past few years of investing, you always see that the dip gets bought, regardless of whatever happens over time. So the stock market is actually positioned and primed and built in such a way that it continue to go up over time. Because as business grows, and as there's more money being printed, there will be an avenue for this money to flow into the stock market, right? So over time, it's designed to keep going up, and because the S&P makes up of the top 500 US companies, the weaker companies will eventually keep getting replaced by the stronger ones. So it makes sense that with better companies taking up the weaker companies and more liquidity, stock will go up over time. So I think as retail investors, if you are not looking to time the market, just live by this phrase, right? Nothing ever happens. Because you have no idea how many times I missed buying or investing because I'm afraid of the markets going down further because of some random news headline that says that the market will crash, right? And even people like Ray Dalio, they just keep saying that, oh, the market is super overheated, now there's going to be a crash. But he's been saying that for the past 10 years, so it hasn't crashed, right? So always look into your money supply and the fundamentals of the companies you're investing in as a signal of knowing when to invest, and not just get driven by a news headline, right? And number 5 is to just take a risk, right? Scared money does not make money. You'll never be able to find and time the perfect entry, find a good opportunity, and just add. So I myself have made this mistake in the past as well, because I was always looking to deploy heavy capital at one go. I was always trying to find the perfect spot to invest in because I was afraid of drawdown and I wanted to catch the perfect bottom. But usually this is not something that's very, very easy to do, and you also need some element of luck over here. So I think if you are afraid, do not invest heavily at one go. Instead, build your positions, and do not be afraid to average up over time if the company is performing well, and don't average down when the company is performing bad. So that's all